So today is all about Monograph, QBO, and Stripe. We're going to be walking through several workflows. So I'm Eileen, VP of Customer Experience at Monograph. Most of you know me either from email reminders, from me asking you to do certain things or asking for feedback. Also joining us today is Kenny. Some of you might also know Kenny from onboarding. He's our senior launch manager. He's based out of Orange County. And then last but not least, Ashish, our Chief Product Officer. Many of you know him as well. He's a voice behind most of these sessions. He's going to be doing most of the heavy lifting until Kenny and I are just asking him questions towards the end. So again, submit your questions throughout. We'll do our best to aggregate them and answer. But without further ado, I'll turn it over to Ashish for today's agenda.
Great. As Eileen mentioned, there's a lot here today. While this is kind of a complicated topic, we're trying to make it as simple as possible. And so to that note, we're actually going to share a little bit about how we like to do things, the Monograph method, as well as then I'm going to walk you through some of the most important parts of the connection between Monograph, QBO, and Stripe. I will say that this isn't completely comprehensive. During onboarding and through support articles and things like that. That will go through every single kind of line item. We're not going to do that, but we're going to focus on, I think, what are the most important and most strategic things. So with that, I'm going to jump into what I'm really happy to talk about this. This is probably this is the first time that we've talked about what we refer to as the Monograph method publicly. And this is really what it is a set of principles on how we do things. Hopefully this has come across when you've used our software, but ultimately we're pretty opinionated software. And we followed these principles in building it. And I'm sharing this because oftentimes there's a lot of questions around, well, why do you do things this way or that way? And the reality is what we're trying to do is we are trying to make the most intuitive platform for you, and one that we can over time completely automate all of the things that you don't like to do, or at least I assume most of you don't like to do. Maybe some of you like it, but you can focus on your craft, and we can handle all the things around running your business. But in order to do that, we do need your help, your partnership in doing things in a particular way. Sometimes I realize that can be frustrating because maybe you've done it in a particular way that works well enough for you. But if you do it this way, our kind of commitment to you is that we will take on more and more of that kind of day-to-day doldrum work, and over time you can focus really on what your craft is. And so I'm not going to go super in detail here. This is just generally, this isn't specific to this webinar, but we're starting to share this. This is actually going to be public on our site pretty soon. I'm excited about that. But I'll just quickly talk about these 5 principles. So the first is that Monograph features aren't optional. Now, that sounds a little harsh. It sounds maybe a little opinionated, but that is kind of our point. Monograph, the power of Monograph is all of these disparate tools and how they fit with one another. We're not the best time tracking tool on earth. We're not the best invoicing tool on earth. We might be the best staffing tool on earth. But but really what the power of this is the data that your people, your staff tracking on their mobile app gets into your invoicing immediately, gets into your staff plans immediately. That's the power. And so in order to do that, you really need to utilize all the features, or it will be just difficult for us to create these kind of ideal workflows where you're kind of doing almost nothing, right? That's the goal. So that's why we say they're not optional. This might be different for those of you that were here maybe 3-4 years ago. There were a lot of gaps in our feature set, and so often you had to kind of bolt on other pieces. We hope that that's, at least for the most part, not the case anymore. So on that same note, simplified workflows over infinite customization. I kind of touched on this before. I know that you guys come to Monograph and you've done things in a variety of different ways. All might be perfectly reasonable, have worked for you for a long time, but we just can't support every single workflow. And if we can focus on the few that work really well, again, we can optimize things. So oftentimes there aren't all the different levers, or hey, I want to see it this way, or I want to do this way. But that's kind of on purpose to keep the software very easy to use. Trust your team and delegate. This is probably the most maybe spicy one that we've run into with a lot of folks. We do believe that you need to push decision-making down as far into the organization as possible. And what that actually means is things like billable rates and how much you're getting paid by our clients. Like the more you trust your team to with that information, the more you can push that decision making out. If you only kind of keep that information with a small subset of your team, or maybe just one person, then that person is doing all the work, and that really hurts you and doesn't scale. Finances are for everyone, kind of related to that. We believe that you don't want to just kind of close your eyes and ask an external person to do all your bookkeeping, to figure everything out. That's totally fine to use that person, but you still need to understand this in your business, and we're hoping that all the tools that we're building help you to do that. And then finally, actionable insights, not reports. We will never have more, like if you go and do a competitive analysis, you're going to say, hey, this tool has 500 reports and you guys have 20 or whatever. Yeah, that's by design. We don't want to have you spend a bunch of time looking through a bunch of data to try to figure out what's going on. We want to tell you what's going on. We want to tell you what's wrong. We won't tell you when things are going well. We will just let you know when things are going off, because everything should be going well. That's the norm. So we really, really focus on, with the dashboard and with notifications, we're telling you when things are off, not when things are on. And so it is different. It's a different approach. And these are all, again, I understand some of this, maybe you agree with, maybe you don't. But our pledge to you is if you kind of follow these and use our software in this way, we will make your lives easier. Cool. So I'm going to get off my pedestal and move on. But the reason I bring this up is because in this particular topic, this is also important. There are a lot of different ways you could connect things. You could be sending your invoices from QBO to your clients. And we are now trying to make it super clear. This is the way that if you follow this process, we can automate, we can simplify. So hopefully this is a little bit of a complicated diagram, but hopefully when I start explaining it, it becomes a little easier. What we're trying to convey here is your clients should be only interacting with invoices through Monograph. And the reason to do that is if they do that, they can see the history of all the invoices they've received from you. They can pay electronically. They can get reminders. Everything is handled, and I'll show you more of this experience in a second. Everything is handled by us. And over time, again, we can automate even more of that. And by doing all that, in the background, you can send your invoices to QuickBooks so that you kind of keep your financials, and your accountant can keep using QuickBooks. And frankly, maybe that's their primary usage. But really, that's the only person in your firm that really needs to be in here. So that's like to do your taxes, maybe to do some detailed reconciliation, that kind of thing. But for the most part, everything else can happen here. And that's also showing, I use principal here, but really anyone else in your firm that isn't down in the weeds of accounting can use Monograph to get insights on their profitability, to kind of look at how things are going, all of that stuff. So this is really how we recommend, and I'll get into more of the details here, but basically this is the overview on how we want you to set things up so that you get the most benefit out of Monograph. Great. So how do you go about doing that? Well, hopefully this is pretty straightforward, but I think it's important to highlight, how do you connect to QBO? So in your settings, there's a QuickBooks section. There's a big old button that says connect. You hit connect. You sign in. You'll see a sign in from the QBO side. You sign in with your credentials, and then if you have more than one company that you might have access to, you'll see a drop down there. Hopefully pretty straightforward. That gets you connected. Of course, there's other steps after this, but just the basics of where you get connected, that's how you do that. Similarly, to connect to Stripe. In your settings, there is, under your organization at the bottom, there is an area to connect to Stripe. And Stripe is how you get electronic payment. We use them. They basically power, they literally power millions of sites, including Amazon and Google and many others. So very reputable source. They handle all the kind of fraud detection and things of that nature that allows us to kind of make this as seamless as possible. You go through a flow, which I won't get into here, but you will have to provide certain types of information depending on the type of business that you are, maybe your EIN number, things of that nature, a particular a point of contact. As you get further and further along, so as you collect more payments here, you may get asked for more things, social security number for that main contact, that kind of thing. That's all part of the know your customer, if anyone's familiar with this, in order to kind of ensure fraud, preventing terrorism, things of that nature. That is why those questions are asked. It's very standard, especially as you drive more and more volume through this. We'll get into this more later, but hopefully, this is a pretty simple process. You can just connect, and then after that, you can determine whether you want to use this in the future, whether you want to use both ACH or credit cards or other payment methods that we might add in the future. That's all options for the future, but just getting connected is free, is easy, and you're done. Cool. So just laddering up, before we get into all the details of everything that you might need to set up, why are you even doing this? Well, hopefully you're getting a great client experience. So here's actually a one-pager that's on our support site that you can have access to if you want to send this to your clients. It has more information on what they need to do, which we can send when we send out the recordings or put in the comments of the YouTube recording here. But basically, what is the point of all this? Well, ultimately, we want you to get paid, and we want you to get paid quickly. Cash is king. Cash flow is normally every small business's biggest concern. So getting paid and getting paid quickly is super important. So, and I'm going to demo this in a second, but I think we have a very simple, standard, clear, and easy to read invoice that your clients can see. They can pay online very easily, either through ACH or credit cards. And then most importantly, they can see all their payment history. They can see every invoice that was ever sent to them, as well as the status of those. So oftentimes what we see, especially with reminders and things of that nature, is coming back here and realizing like, oh, I have unpaid invoices, I need to pay them, is very big. And so just a quick stat here for Monograph customers that use this system, that utilize electronic payments, they only write off about, and when I say write off, I mean like have unpaid invoices after, say, like about a year, of 1%. Whereas if they don't use this, that number is 5%. Now you have to determine in your business if this is an issue for you, but I would say on average, Monograph customers are effectively paying a 4% hidden fee by not using electronic payments. Oftentimes we get questions like, well, checks are free, or ACH through my bank is free. Well, is it? Because actually the added friction, the reconciliation, the kind of mistakes that tend to happen through those processes actually add up, and you might not see it as obviously as a line item that says you got charged $15 on an ACH, which hopefully is not very much, but it is an actual fee that you get charged. But I think it is actually more clear that this generally is good. So I'll get off my soapbox again, off that one, and I am going to switch. I went into a private window, so I'm gonna have to switch screens here 1 second, but I'm gonna show you the client experience. 1 sec. Okay, share my screen. This one. Okay, great. Eileen, let me know if there's any problem seeing this. So yeah, this is an example. Obviously, this is just for this webinar, so a complete example here. Invoice, pretty clear. I think everyone hopefully is somewhat aware of what our invoices look like. And I'll get into this in a second, but they can either, if it's a repeat customer, a repeat client, I should say, which 60% of our payments actually are paid by people that have come back for a second time. We know that architecture in general relies on a lot of repeat customers, and so that's actually a really cool stat. But if it's their first time, they will check out as a guest. Oh no, here we go. Okay, sorry. Sometimes you do a live demo and things. This is a demo environment, just to be clear. So there are a few little tweaks that are different. But yeah, they'll see what you would expect. I mean, hopefully this isn't rocket science. This is like, anyone that's paid anything online have seen something like this. But basically, they can pay with a card, they can pay with bank. You can determine whether you want to include those or not. You can also determine if you want to pass those fees to them versus have them yourself. We would recommend not passing those fees and treating that as a cost of doing business, because you generally don't want to kind of slow down and discourage people from using these payments, because again, you're getting a lot of benefits from that, but it is up to you. So yeah, and this is a little bit different because this is a demo environment, but normally what you'd see here is banks like Chase, Bank of America, et cetera. So a lot of the bigger banks, they can search for their bank. And if they go through that process, all they have to do is put in their credentials and they're done. No routing numbers, no nothing. And most payments tend to use that as long as they're using a major bank. Now, we do know that a lot of folks maybe are using a credit union or some kind of smaller entity that doesn't have that. And in those cases, they can enter numbers manually. Cool. I'm going to move on from this because hopefully that's not oh, sorry. The one other thing I wanted to share on this screen, which for some reason isn't showing, but that's okay. Oh, I know why. Because it's a demo environment. When you put your email address in here, which is required, the next step will ask you whether you want to save that payment method. So if, for example, they use the routing number method, which can be a little bit more cumbersome, they can save that and use it in future instances. That will also allow them to see their history of all their payments, as well as any other invoice that has been sent to them and outstanding, et cetera. Cool. So yeah, I think this is the whole point of this is it should be a very simple experience for your clients. So that's what we're aiming for. I'm just going to go back to my other screen. Great, it's still in presenter. Cool. So now, what do you need to do in order to get that experience? Well, first, I'm going to talk about things that we keep in sync between Monograph and QBO on a regular basis. Basically, once you connect them, they stay in sync. And those are specifically clients and consultants. I'm not getting into some of the smaller things like your terms, but these are the major ones that matter. So in this example, hopefully, again, this is fairly straightforward. What you do is you can have clients in Monograph, you can have customers, as they're called in QBO, you link them together. Similarly with consultants, you have consultants in Monograph, you have vendors in QBO, and you can link them together and then they stay in sync. So I'm only going to show you clients, but the same thing happens for consultants. It's effectively the same. If you want to do this, you can either do it here from your QuickBooks settings. So basically, in your settings, if you just go from the top to the bottom in QuickBooks and do everything, you're going to be in great shape. Just follow those steps. But so one of the first steps is importing your clients. If you already have your customers in QBO, which most of you probably do, this is probably the easiest way to do it. Now, of course, if you've been around for a while and you have your clients in Monograph, you can do it the other way. But either way, so yeah, when you go to import clients here, you'll see that there. You can also do it here in the client directory. So those are the two places that you can do it. And when you do that, what you'll see is a screen like this. This will show all of the customers. I got to make sure I use the right terminology. The QuickBooks customers that we've detected are new, which basically means you haven't told us how to connect them if you should connect them. And then over here, you'll see an option to merge these with a Monograph client. So again, if you're brand new, hopefully you don't have to worry about this at all because there's no real need to merge them since you don't have any clients in Monograph. But if you've been around for a while, or there's just a one-off one where you happen to add it in Monograph before you add it in QuickBooks or before you pulled it in, you can merge it here. And so there's a drop down here. You can search that. We will do our best to actually try to match that automatically. But if we don't determine that, you can search on your own. So hopefully that's pretty straightforward. And yeah, so basically you just select the ones you want, merge it, and that's it. Cool. That's hope that was meant to be easy. So now maybe slightly more tricky things. Invoices is probably the biggest one that has a few pieces that we're going to talk through, and then we'll also talk about expenses and bills and how those get into QBO. Okay, cool. Just a reminder, invoices. The client interaction is all through Monograph. So, so here's kind of a general idea. You create an invoice on Monograph, you open it, you send it to your client, ideally through Monograph, and then the next step is you also then send it to QBO. Once you do that, well, I'll talk about this in a second, but once it gets paid, all those things will sync after that. And again, the goal here is to really just use QBO as effectively an accounting ledger. The only reason to even send the invoice there is just to make sure you have that transaction. It's not to then send that to a client or to use it in any other way. It's really just a transaction. Okay, so what do you need to do in order to do that? Again, in that same QuickBooks settings page, just keep scrolling down and filling everything out. You only have to do this once. What you're going to do is you're going to map all your phases, all the phase types, I should say, that you have in your setup to a product or service in QBO. So basically what this is trying to do is say, hey, when we bill time to bidding and negotiation, or sorry, when we charge our client money to bidding and negotiation, that should go into this service. In some cases, that will be one-to-one. Some people might just have a single bucket called architectural services. You know, it's up to you. But this allows you to kind of map every single phase to an individual service if you choose to. So you'll need to fill that out. If that's missing, what will happen is when it gets sent, any line items that are in these phases will just not be mapped to anything. So you don't want to do that, obviously. So that's really actually all you really need to do to get the invoice syncing working. I'll talk about a few other things in kind of more esoteric situations. Okay, so the next thing is when you are sending those invoices, by default they will be connected to the client that you've already synced with QBO. But for those of you that might use the concept of sub-customers in QBO or for QBO projects, what you can do is on any given invoice, there is this drop down on the left with under QuickBooks where you can change what we refer to as the accounting destination, so that basically you can go one level deeper. So again, hopefully, to be honest, I hope most of you don't use this, but if you do use these features in QBO, this should be pretty straightforward. This just allows you to say, it shouldn't go to Bill's windsurf shop as a whole. It should actually go to a specific store under that. And that allows you to do some of the project work and all that kind of stuff. I would argue you can get all that project data in Monograph, so there's no need to do this. But if you so choose to, you can. Great, taxes. Some of you might have to deal with taxes. Again, not all of you, but certain states, certain locales might need this. So the way taxes work, and I won't get into all the details. We have very good support documentation that will walk you through all of the kind of nitty-gritty. But the basic idea here is QuickBooks has already done all the hard work on figuring out, either you've set them up or a lot of you probably have, I'm going to forget the term, but basically the automatic calculation of tax rates. So we're going to rely on that. We're not going to reinvent the wheel here. So basically what we do is you create the invoice, and in that process, when you're connecting it to QuickBooks, we will pull the tax rates back from that and then calculate the taxes. So that's the high level. Again, there's very great documentation on exactly how that works, but just so you get an understanding of where those tax rates are coming from, they're coming from QuickBooks. And then finally, payment syncing. So in most cases, again, if you're following the Monograph method and your customers have, your clients have received an invoice on Monograph, have paid automatically, that's the ideal scenario, right? Because then what happens is they will get marked as paid automatically in Monograph. They will also get marked as paid automatically in QuickBooks. One thing I will note, in order to do that, again, it's on that same page, there is a section around the accounts that you want set up for either manual payment or Stripe payments. That we need that to know how to create the journal entries for those situations where either you mark it manually as paid or it gets paid through Stripe. And so when you do that, we handle everything. I will say, for those of you that are really down in the weeds, we are making one improvement, which is coming soon, such that if you absorb the fees, we will also create an extra journal line entry to represent that. Today, that requires a little bit of manual work. That will go away very shortly. I know that that's a pain point for those of you that are using that. Okay, but in the scenario where maybe you took a paper check, you really had to, maybe somehow you got a payment in some other way, and that is coming through in QuickBooks, we also will sync backwards. So basically, when you mark that transaction or when you apply a payment towards an invoice, that will then go back and be reflected in Monograph as well, including partial payments. Great. All right. So that was mostly invoices. Again, if you do all that, then all of our reporting, all of the I'll get to it in a second, profitability, all that stuff will be in good shape. All right, now let's talk expenses. Okay, we have two concepts in Monograph, reimbursable expenses and non-reimbursable expenses. Reimbursable expenses are things where most likely one of your employees has paid for something and you need to reimburse them. They can be billable or non-billable. So billable meaning you're going to charge it to the client, non-billable meaning you just need to reimburse the employee. We handled all of those cases. With the mobile app, they can take a picture, and that's the way that works. So for these, it's pretty straightforward. These will come through. When you send them to QuickBooks, they will come through as bills, QuickBook bills. And so what you need to do, again, in your settings is choose, I'll show you that in a second. So maybe I'll table that for a second. But basically, that's what happens. They're bills. The other thing is non-reimbursable expenses. These always trip all of us up, including myself. These are things that have already been paid for, not by the company, not by a staff member. So most likely this is a credit card, a company credit card, right? Or some other invoice that you paid somehow but not through an employee. But the only reason, frankly, for those to be in Monograph is because you need to bill them to the client. If they don't need to be billed to the client, there's no reason really to put them in Monograph. But if you do put them in Monograph, they are billable, and you want them to go to QuickBooks and they aren't already there. This is an important thing. So if you, for example, sync your company credit card to QuickBooks already, then those transactions are probably already there. So there's actually no reason to send them again. In fact, you're going to create duplicates. But if that is not the case, if you paid some other way or you don't have those linked already, what you can do is send those, and those will just end up as expenses, but they will just credit an asset account directly. They will not go through like a payable account. So that's actually what I'm going to talk about right here. So there are two types of expenses. The reimbursable expenses, those go to a payable account. So this comes up very often because the payables clear, everyone understands that, or most people I think understand that. What gets confusing, and that's why I was trying to be really clear here, these are expenses that have already been paid. So when you send them, you actually are going to choose from an asset account, not a payables account, because you're going to want to know, or we want to know which account did you pay this out of, so that we can create that transaction for you. So that's why this is not a payables account. It's actually an asset account. Cool. Hopefully that was the most complicated accounting that we'll be doing today, but I just wanted to let everyone know that because that comes up a lot. Oh, and then how do you actually do this? So you just go, after you've set it up, when you go to the expenses report, or sorry, not report, but under the money tab, there's an expenses section. Right here on the more, you hit send to QuickBooks, and then you will see a list. You can search any time period, and you'll see a list of all your expenses that haven't already been sent to QuickBooks, I should say. And then I didn't show it here, but happy to if anyone's interested. Just like everywhere else throughout the product, once it's been sent to QuickBooks, you'll see a little QuickBooks icon to show that it's already there. That would be below here. Great. All right. I know we're covering a lot of ground. I'm assuming some questions are coming in. Keep them coming. Okay, bills. In a lot of ways, bills are similar to reimbursable expenses for at least when it comes to QuickBooks. But obviously in Monograph, we think of consultant bills in a very particular way because these are bills coming from a consultant. You're going to bill them to your clients. But in terms of the QuickBooks side of things, it's very similar. What we actually allow you to do slightly differently because of kind of the wide range that could come in is on any given bill, you can actually specify the QuickBooks category. And then when you go to send it, then that will be handled for you. So similar, like unlike that other one where all expenses kind of go to one place, these can be categorized on a bill-to-bill level. So I showed you one, or I'm showing you here one version of that is like when you actually create the bill, you can choose a category and click on this, and you can either send it to QuickBooks immediately, or if you don't check on this because you're not ready, maybe you're going to look at it, whatever, you can send it later from the list, very similar to how we did on expenses. For the sake of time, I'm not going to go into that, but you can just go to the bills page and see that. Great. All right. Take a breath. That was all the like nitty-gritty stuff. This is probably the most complicated, but also I think the most powerful section. So I'm really excited to show this to you. So this is how we can help you figure out what is profitable in terms of your projects. And like remember earlier I said you probably don't need to be using QBO projects. I hope that's because this is far superior and a lot easier to use. But basically, what we'll do here is we'll talk to you about how we pull in your costs from QBO, things that we maybe are not in Monograph already, and then give you a very accurate picture of how profitable you are running. Okay, bear with me. I know this is a little ridiculous, but let's. Hopefully, this will help clarify some things. How do we actually calculate profit on Monograph? So profit is revenue minus costs. Great. Where does the revenue come from? The revenue comes from Monograph invoices. That's the only place it comes from. It's based on your issue date of your invoice, and that is basically when we are, considering that revenue recognized. Costs. Where do those come from? They come from two places. So number one, you're most likely, if you're like most of our customers, your number one cost, your biggest cost is paying your employees. And so the time logged on Monograph is critical to be accurate, to be filled out every week, for us to very accurately apply costs, those labor costs, to your different projects. So we are using that in conjunction with the salary information that you provide in Monograph. That is the way that we handle the vast majority of the labor costs. I'll get into what I mean by vast majority in a second. And then we layer on top of that all the expense account transactions from QBO to handle a bunch of other types of costs. Again, I'll show you this in a second, but this is kind of how this works. And the whole goal here is to have this fully attributed to individual projects and or overhead so that you can get a good sense of if you're running profitably on a project per project basis, as well as just as at a firm level. Okay, so I talked about this before. I'll actually show you a demo and I'll walk you through this in even more detail. But again, we're trying to give you a project profit number for each phase actually. And then what we're doing is we're pulling in a bunch of costs from QBO, which are project specific costs, which are basically like things like, I don't know, ate at a McDonald's near the site visit, and therefore that should count towards this project. Labor costs, we have health insurance for employees, and again, employing people is the #1 thing. We also, this is for project profit, and then for company profit, which I'll show you in a second, we also have operating costs like rent and non-operating costs like interest or things of that nature. Okay, so for the sake of not having a million slides, I'm going to attempt to do another demo here. Okay, so this is, again, demo data. Very good demo data. This person's very profitable. But basically, this is any given project. You can go into the profit tab here, and you'll be able to see phase by phase, as well as a separate line item for consultants and expenses that will show you how profitable you were on each phase. Again, the revenue is purely from invoices, and the cost is a combination of the time worked on this phase based on the Monograph timesheets, as well as labor-related costs, which I'll show you in a second. So how do I set this up for the first time? I am going to go, oh no. Zoom is blocking me from accessing this thing. Oh man. How do I move this annotation thing? Oof.
Ashish, I can chime in because I lead webinars. If you actually zoom into your, oh, what's wrong with my camera? If you zoom into the browser itself, Command plus, you can get
okay.
annotation. Yeah.
Okay, thank you. We need to give Zoom some feedback. Okay, all right. I'm gonna zoom back out now. Okay, cool. So now I'm in my settings. And if you go to QuickBooks, like I said, everything's always on this tab. So in this example, I haven't filled everything out because this is a demo account, but I will show you all the way down here. If you have never done this before, there would be a big button here, but in this case, I already have done it, but I can still show you how this works. Okay, great. So I talked about this a little bit. Now, bear with me. This is a little complicated, but I actually hope that it's not as complicated as it looks on first blush. So we have these different types of categories of costs. What am I doing right now? I am looking at every single QBO expense account possible on my QBO instance, and I'm trying to tell Monograph whether the expenses under this are what category they are. Are they project-specific costs, which could either be things like what I was saying, like I'm visiting a site, or it could be consultants. If it's consultants, you ideally would tell us that as well, so that we can separate out consultants from kind of typical expenses. But basically, again, these are all of the accounts where the expenses from here are likely going to go to a specific project. What this also means is the expenses that will come through here, you will need a second step where we try to do our best to guess, or not, I shouldn't say guess, but to match those expenses to the project. But you will have to review that and make sure that, for example, this cost from this particular consultant was meant for this project versus this. The wages, okay, so you pick a bunch of things here, you specify this. Then you go to the next one. Wages are basically just all of the accounts that are paying your employees, not benefits, not other stuff, just literally either their salary or if they're hourly, like the amounts that you're paying them. So that's all that should be in here. And the reason for that is we actually ignored the expenses in here on purpose because we already have that information in Monograph and we don't want to double count it. Okay, labor-related costs. These are costs that you can use your judgment, but are anything that is related to how you employing your staff. And the reason for this is these are costs that are going to be included in your project costs because we believe that obviously paying your workers their actual salary is part of it, but what are all the other things? Now, when we say this, these are things that are directly attributable to like maybe hiring one additional person. So we would not put rent we would not put, things that don't really scale that way, but rather things like health insurance, payroll taxes, I don't know, some software subscription, things that scale with your individual employees. Again, a little bit of nuance there, and you can use your best judgment. But really what this means is if you include this, it is going to go into your project profitability. I would argue that things like rent or fixed costs should not go into your project profitability, because a project could be running well, but you might just have a bunch of overhead, and those are two different problems. And that's why we have those separated. So to that note, things like rent, things like fixed costs, those should go under operating costs. Those are things that, whether you got a lot of projects or not, you're still paying those numbers. And so again, that shouldn't really affect whether your projects are profitable or not. And then finally, probably not used a ton, but for non-operating costs, things that are like interest and things of that nature, you're going to see that here. And that's really kind of helps you whether you have a financing challenge or things like that. The entire point of all of this is when you are doing, when you are looking at your business, you can see kind of effectively where your problems are and where things are good, right? So when this is the company level profit chart, and this breaks this down by all these different costs. So again, direct costs are costs of running your projects. So if your revenue over your direct costs is positive, but your operating costs and your non-operating costs drive it to negative, then you know that, okay, I got to work on my fixed costs. But if your revenue over your direct cost is negative, now you got a bigger problem. That means you're not running your projects on a profitable basis. And similarly, let's say the direct costs and operating costs add up to less than your revenue, but now your operating costs are bringing you down. Okay, well now how are you financed or what have you? So that's trying at a very high level, hopefully a very simplistic level, we're trying to give you that kind of insight. Now, of course, you don't want to just break even. So obviously you can set targets and things of that nature, but that's really up to you. Yeah, and so that's how all of those costs work. I know there's a lot there. And I, as much as I tried to keep it simple, I am also going to have to go a little bit more in the weeds because we have some common questions here. But before I do that, one last thing I did want to mention, you do need to, or maybe I can, sorry, I'm going to quickly show you if I can get back in here. I'm going to quickly show you, so that all of the mapping of the accounts, that's a one-time thing. You do that one time and then you're done. On an ongoing basis, you'll get notified if new transactions come in that we don't know how to categorize. In this case, these are all actually categorized, so it's you didn't see that. But if, let's say, they weren't, I can come in here, look at the transactions and say, actually, this is a project cost and it goes to Octavia Street. So I can do that in here and you'll be prompted to do that. So that's, maybe you're saying, okay, that's a little onerous. Well, the truth is, and that's why I have this thing here, if you've sent an expense through Monograph, if you, like it was on Monograph and you sent it to QBO, if you sent a consultant bill from Monograph to QBO and you've, as I was saying earlier with the invoices, if you've mapped those down to a QBO project, we will be able to automatically assign all of those things to the project. So you won't actually have to, pick and choose that one. And we'll also learn over time. So the amount of cost categorization should go down over time and hopefully won't be very onerous. Okay, great. We're getting towards the end. I know we have a lot of time for questions, or we won't have a lot of time for questions, but I think this is really important. Okay, I'm gonna roughly run through this, trying to be as simple as possible. So how do we calculate project costs? First, we take all the QBO project specific costs. So that first bucket that I said, those are just directly like this transaction went to this project, done. Hopefully that's straightforward. The next thing we do is we calculate a labor multiplier. This is probably the most complicated thing we do. We take the last 365 days of your QBO labor related costs. So everything in that bucket where you said, hey, this is health insurance, this is payroll taxes. We take that number, and then we also then we divide that by the last 365 days of salary costs that we have in Monograph. The reason we do this is we're effectively creating this labor multiplier. And the reason that we take 365 days is because we know that a lot of people have lump sums for, say, an annual bonus, for how they pay health insurance and that kind of thing. In your typical, in QBO, for example, unless you, maybe you're, I mean, you can get around this, but in a lot of tools, what will happen is projects that happen during that time, say like you send out an annual bonus in December, projects in December will suddenly look really unprofitable. And you're like, well, what's happening? What's going on there? So we don't want that. So we are smoothing that out such that you don't run into those kinds of issues. So that is probably one of the most complex things, and I'll talk to you about on the next page about why, when your numbers don't quite match QBOs, that this is the most likely culprit. But again, we're doing that because we believe that that's a more accurate way for you to understand if your projects are running profitably. The next thing we'll do is hourly employees are really straightforward. We just take their hourly rate, figure out how many hours they, multiply by the number of hours, and then multiply by this labor multiplier. Boom, that's the cost. For salaried employees, a little bit more tricky. We look at the timesheet data every single week. You need to have that filled in. If it's not filled in, it's going to all end up in overhead and not in projects. We take the amount of money that that person would work that week, that would get paid that week, that salaried employee, and then we distribute it based on a percentage basis based on those projects. This is different than a lot of tools that just use some kind of cost rate. This is more accurate. The reason it's more accurate is because if someone works, 80 hours that week instead of 20 or 40, in a typical cost rate world, they would dramatically overestimate. You didn't pay them for 80 hours. They're a salaried employee. You paid them for 40 or whatever the average number is. So those methods, they kind of work on average, but ours actually work exactly. So you get paid a certain amount every week, and that gets distributed no matter how many hours you work that week, as long as, of course, you have the percentage, you filled out everything you did that week. So that's a little bit more tricky, and the main thing, again, is make sure that's all there. And for any non-project work that week, that will go into the operating costs. So I'll talk about that in a second. Okay, so how do we calculate total costs? So everything up here, project costs, direct costs, those are kind of the synonymous. So these are all project costs. Non-project work, so like overheads and things like that, those go into operating costs. And then, of course, anything that you took from that transaction list and said was operating costs, those also go into operating costs. And then anything you categorize as non-operating costs go into non-operating costs. So I think hopefully most of the stuff is pretty simple, but it's really some of this labor stuff that's a little more complicated. So last slide, and I'm going to belabor this a little bit. Why doesn't Monograph match QBO? We get this question a lot. I totally understand that you want to make sure it's right. But if we gave you the exact same information, then what are we actually doing? So again, Monograph is trying to tell you if you're running sustainably. It's telling you, hey, this project was profitable. Yes, maybe some stuff happened, you paid out a lump sum and you did this thing. But like in general, you can take more projects like this because you made money. That's the goal. QBO, understandably, they're just trying to tell you, like, most of you probably do cash-based accounting, maybe not everyone. And they're basically just telling you, cool, you made money this month or you didn't. Very important information, don't get me wrong. But what Monograph is trying to tell you is, are your projects running profitably? What QBO is trying to tell you is just overall, are you running profitably? And again, I think we can also help you with that question, but it is a little bit different. So that means that, and again, the main difference is probably that smoothing of that labor-related data. So what it also means is, while in any given month, you might see some discrepancies, if you take like a year, it should almost be exact or within, a small amount, just some rounding and that kind of thing. So if you don't see that, then there might be something else going on. But generally speaking, any given month could have some variance depending on how your labor-related costs are coming in. And then the last thing I'll say, I think I referenced this before, but oftentimes things like QBO projects, when they are providing you costs, they might be using a cost rate for an employee. Whereas, again, what we're doing is, like, especially for specifically for salaried employees, we are applying more of a distribution mechanism. And I think that that helps prevent some of those challenges. Okay, cool. I hope you guys are still with me. It was a lot of content, but remember what the client experience is going to be. It's going to be super easy, and you are not going to have to worry about most of this as long as you set it up right from the beginning, which is this diagram right here.
So with that said, we'll move over to the Q&A. Ashish, thank you so much for covering all this topic. I have been seeing great questions, both that are questions probably appropriate for here, for the support team, but I want to start something that I've seen a couple and that were similar. So I think there's a lot of companies that are here present, their admins are present, and they are maybe not totally convinced that they should be doing this, right? And so I received one question which essentially asked like, hey, like, I get that there is like a benefit to having like your invoice in Monograph versus QBO, but like what else, right? Like, is it just like that it's easy to import and the data, like what's, can you recap again, like what is the big benefit there? And then the second half of that question was, there also seem to be several mentions of clients that are just resistant to give up paying by check, right? And so do you have any words of advice for firms that are trying to convince these clients to switch over paying by checks? What are some of the benefits that they're going to get as well?
Yeah, okay, great. So on the first point, well, I would say, I hope everyone is using Monograph to create their invoices, because we're going to make that whole world a lot easier. Again, the power of Monograph is we take all the data that you've logged, all the time that you've logged, your budgets, and like provide you a relatively, hopefully even easier over time. I'll sneak peek a few things that we'll be doing soon. We'll be creating batch invoice creation. We'll be supporting writing off time. There's a bunch of things that we're innovating here on the creation side of invoicing. So if you're not actually even creating invoices on Monograph, I would highly recommend you change that very soon, because there's just so much work that I can't imagine there's a world where you're not doing a lot of work to create invoices if you're doing them, for example, in QBO and not in Monograph. So assuming that you mean that we're creating them in Monograph, but we don't really see the benefit in, for example, sending them to the customer, to our client there. I think things like reminders, things like the more automation that we're going to provide, the portal that you have where you can see all the history, those are all things that, while I understand that QBO has some of that stuff, this is all kind of just built into our flow. QBO, as far as I know, does not have any kind of history. Based on me paying my contractor, I can never find my old stuff. But also, like, generally speaking, all of the things that we provide continue to do that, and will continue to make the client experience better and better, and we are constantly improving that. For example, later in the year, we anticipate adding into that portal the ability to share like your Gantt and things like that. So again, like things that are just more related to the A&E space, I think that will continue to happen. In terms of syncing, I think again, like you're just going to cut down on a lot of work by just passing this data to QBO and then just having it as really, we think of it over time, we just think QBO is your accounting ledger, and that's really it. It doesn't need to, you kind of don't need to be doing client-facing work there and in Monograph. It just seems like a lot. That would be my main pitch for why you would want to do it here. Mainly, like, we're continuing to innovate, and we're going to make this easier and easier. So if you kind of get on board now, it will make life even easier. We'll probably be creating automatic creation of monthly invoices down the road, like a bunch of more optimizations here, so that you kind of don't have to do very much. That would be my thing. As far as convincing people with paper checks, I mean, look, it depends what the reasons are, right? If it's for transaction fee reasons, again, I would implore you as the kind of service provider to not pass those fees on to the client. Again, you're going to get a lot of benefits out of it. You're going to get paid faster, which I didn't really even talk about, but the average person, if you're using credit cards, on average get paid in like 3 days from when they were sent from Monograph versus, maybe like 3 weeks for ACH. And if you don't use payments, it's like, 6, 7, 8 weeks on average. So there's time, there's actually getting paid, there's reducing friction, all of those reasons, right? So if they are stuck in their ways because they're, I don't know, a university or financial or like some company or whatever, I probably, you're better suited than me to answer that question on how you could convince them. And maybe you can, but even if you got, 80% of your payments happening this way, you're going to save yourself so much time and energy that you're not following up on people, you're not doing these things, and then you can maybe focus on just trying to convince that small group. So I would say, and I'll admit that even of our customers that are highly utilizing it, there are some that, especially like if you're using residential, you can maybe get to 100%, but others that it's hard to get to 100%. But even if you get the benefit, in most of the cases, it will still be worth your time and energy.
Awesome. Kenny, I think we might have time to squeeze one last question. I still see that the majority of the participants in the audience are here. So let's have one more, and then that way we're not taking up too much time.
Yeah,
over.
so one of the themes that I've noticed in the questions is in regards to smaller firms who are taking like a dividend pay versus a salary pay. As you mentioned earlier during the cost portion, right? We're taking the salary. How would you handle that in Monograph in regards to folks who take like a shared cut of the profit?
Yeah, that one's a little tricky. So what I would say is there's kind of two approaches. One, you could apply, probably my recommendation would be provide a salary for that person, probably the owner, that's maybe the average or even maybe a little under what they might take, because and so do that, and then include the portion that kind of is a differentiator from that number as a labor-related cost. You could just put it all in labor-related costs. That's probably the easiest thing to do, to be honest. However, the problem with that is then basically that multiplier is going to be applied to everyone, not just that principal or that owner. So I think the ideal way would be potentially just set up a salary that is as close as possible to that amount, and then just create a variance when, maybe once a year or something that actually says what they got instead.
Cool. So I think we're right on time. There's still several open questions. What we typically do when we have this many questions is we try to update our help docs documentation with anything that makes sense to put there. I did see a couple of questions come through where I did recommend, and I hope I was able to capture all of them, to actually reach out to the support team. Sometimes if you submit a question that's really, really specific, we're not really able to answer it live because we need to look at your account, look at the project, see what conditions might be happening there so that we can advise you on next steps. So if you are the one, there were several of you that submitted this, I let you know, but if I didn't catch it, please make sure to reach out to us. You can use the chat bubble within the app, or you can email us. But usually the chat bubble is the best way and is the fastest way. Thank you, Ashish, as always, for guiding us through a difficult and heavy topic, and Kenny for being my wingman. I cannot believe we got pretty much 40 questions answered between live and in the chat. So thank you both.
Wow, the real heroes. I was just babbling away. So yeah, I love it. Thank you. And thanks
You
everyone.
probably thought we weren't paying attention. We're just like rapidly typing over here.
Never.
Awesome. All right. Have a great weekend, everyone. Thank you for joining us.